Okay, let's be honest. You've probably got something from Kraft Heinz in your kitchen right now. I mean, we all know the ketchup, the mac and cheese, but while the products are household names, the company's stock, well, that tells a much more complicated story. Today, we're going to open the case file and figure out what's really going on.
And that brings us right to the heart of the mystery. When you look at the numbers, this stock looks cheap. But is it a genuine bargain, what we'd call a deep value investment? Or is it a classic value trap, something that's cheap for a very good reason?
So we're going to do this like detectives. We'll break down the evidence, we'll scrutinize the numbers, and piece together a verdict. Let's get our investigation started.
To really get a handle on the stock, you've got to understand the business first. And with Kraft Heinz, it's this fascinating story of old-school, powerful strengths clashing head-on with some pretty serious modern-day challenges. So, who are we dealing with here? A global, packaged food giant. I mean, the brands are legendary. Heinz, Kraft, Oscar Mayer, you name it. But here's the puzzle piece that doesn't quite fit. They're playing in a very mature, slow-growth sandbox. They're in a slugfest with cheaper store brands, and because of that, their revenue growth has pretty much hit a wall.
So that's the setup. Now, let's get to the first juicy piece of evidence, the numbers. An analyst went and did the hard work to figure out what the company might actually be worth, completely separate from its day-to-day stock price.
First, just the facts. As of this analysis, the market is pricing a share of Kraft Heinz at about $25. That's our baseline. Keep that number, $25, locked in your head.
Now check this out. The analyst calculation for the company's true or intrinsic value comes out to $39.50. Whoa. You put that next to the $25 market price, and you can see the appeal right away. It suggests the stock is trading at a potential 37% discount. This right here is the whole deep value argument in a nutshell.
So, you're probably asking, how did they get that number? Well, it's not magic. The valuation is a blend of two different models. One is a discounted cash flow, or DCF, which basically tries to guess all the future cash the company will make and figures out its value today. The other is a multiple exit value. You average them out, and you land at that $39.50 figure. You add in a low price to free cash flow ratio, which means you're getting a good deal on the cash it's generating, plus a really beefy dividend, and yeah, on the surface, this thing screams classic value play.
But hold on. A 37% discount doesn't just happen for no reason. You know, the market isn't blind. It's seeing some risk there. So we need to roll up our sleeves and really dig into the company's financial health to see why this gap exists.
And here it is. This is the whole story. The core financial tension right on one slide. On one side, Kraft Heinz is an absolute cash-generating machine. It just prints money. But on the other side, that amazing strength is being weighed down by a ton of debt and really weak profitability and growth. It's a constant battle inside the company's own books. Let's look a little closer at this profitability problem. I mean, the 5-year revenue growth is actually negative. That's not good. The average profit margin is razor thin, just 2.69%. And maybe the most telling number here is its return on invested capital, or ROIC, at just 4.82%. Think of ROIC like a report card for how good a company is at using its money to make more money. And frankly, anything below 9% is a sign it's struggling to invest its capital well. Then you've got the balance sheet. The debt to equity is a little on the high side. And this next one, wow, this is a big one. It would take almost 10 years of the company's free cash flow just to pay off its long-term debt. Think about that. And the current ratio, which tells you if it can pay its bills in the short term, is also pretty tight. I mean, the balance sheet isn't about to collapse, but it's definitely not what you'd call comfortable. But, and this is a huge but, despite all those problems, our investigation always leads back to the company's one undeniable, rock-solid strength: its ability to generate cash. It just consistently churns out over $3 billion a year. This is the engine for the whole investment case. It's what pays that big dividend and keeps the lights on. Okay, so we have this tug of war: strong cash flow versus weak growth and high debt. So how do these things actually balance out? Let's zoom out a bit and use a weighted analysis to look at the company's overall strategic position. This table really helps put it all in perspective. You can see the strong brands and free cash flow get high scores and are weighted heavily, but man, they're getting dragged down by those really low scores for high debt and slow growth. The final weighted score is 5.85 out of 10. You know, it's decidedly okay. It's not a complete disaster, but it's definitely not a screaming buy either. And this quote from the source analysis just nails it. Kraft Heinz has a competitive advantage, what investors call a moat, built on those iconic brands. But that moat is getting shallower.
It's slowly eroding as people's tastes change and those pesky store brands keep chipping away at it.
So knowing all this, what could the future actually hold? Let's game out a few potential scenarios and see what they might mean for an investor's ideal buy-in price.
Here we can see 3 possible futures. In a pessimistic or bear case, with pretty much zero growth, the stock might only be worth $30. The base case, which we've been talking about, is that $39.50 number. And in a more optimistic, bull scenario, where they manage to improve things, the value could be as high as $48. It just shows you the wide range of possible outcomes.
Okay, this brings us to the really practical question. What price should an investor actually pay? This table lays it all out based on what kind of long-term return you're looking for. If you want a modest 7% annual return, well, buying at today's $25 price works. But if your goal is a more ambitious 9% compounded return over the long haul, this analysis says you need to buy in at or below $20 a share.
All right, we've examined the business, the valuation, the financials, the risks. We've looked at all the clues. It is time to review all the evidence and officially close this case file.
But before we get to the verdict, let's just make sure we all understand the main danger here. A value trap. It's a stock that looks cheap on paper, but its actual business is slowly falling apart, so the stock never recovers and your money just gets, well, trapped. This is the absolute key risk with a company like Kraft Heinz.
And here it is, the analyst's final recommendation, and it's smartly broken down for different types of investors. For folks who already own it and are just in it for that dividend income, it's a hold. For new investors thinking of jumping in, it's a cautious buy, but only, and this is important, only below $22 to give yourself a cushion. And for investors looking for strong growth, it's a not yet, because at today's price, it just doesn't clear that 9% return bar.
So if you remember just one thing from this whole analysis, make it this. Kraft Heinz is a fantastic cash-generating business, no doubt about it. But the market has put that stock in the bargain bin for some very real reasons. Too much debt and a serious lack of growth. The discount is there for a reason.
And with that, this investigation is officially closed. But you know our work is never done. What company's case files should we crack open next? Drop your suggestions in the comments below, and we will see you on the next one.